Hello everyone, I am Leela Prabhugaonkar and I am from the Bodhi Academy. Okay, so today we have already started with Unit 8, Government Budget. Okay, and last class we have discussed with regards to meaning of government budget, then objectives of government budget we have seen, then structure of the budget or component of the budget. Okay, these things we have learned. Okay, which are the what are the different structure, what are the different components of the budget, this we have studied. So in structure of the budget or component of the budget we have seen that budget is classified into two types. Okay, we have seen budget is classified into two types: revenue budget, and capital budget. Okay, so revenue and capital budget we have seen. So a structure of the budget, it refers to the components of budget and it has two broad components. These are two broad components, revenue and capital budget. Okay, so revenue budget includes revenue receipts and revenue expenditure. Further, we have seen that this revenue budget includes revenue receipts and revenue expenditure. Revenue budget includes these two, revenue receipts and revenue expenditure. Okay, then capital budget includes capital receipts and capital expenditure. This we have seen for the previous class. Okay, capital receipts, and capital expenditure. Again, we have seen the classification of all these things, that revenue receipts is receipts which do not create a liability or reduction in the asset. Okay, so that is a revenue receipts. Then revenue receipts is further classified as tax and non-tax receipts. That we have seen, tax and non-tax receipts. Non-tax receipts. Okay, then revenue expenditure. Also, we have studied which are the different tax receipts, that is progressive, ad valorem tax, direct and indirect tax. Okay, direct tax includes your wealth tax, your income tax. Indirect tax is basically your GST. Okay, indirect tax is levied on goods and services. Indirect tax is levied on levied on goods and services. Then direct taxes is on wealth tax, your income tax. This is your direct tax. Okay, then we have got progressive and regressive tax. Progressive tax is a tax which that increase in income the tax rises. Okay, then regressive tax implies that the rate of tax decreases with increase in income. So this we have seen. Then also we have seen value added or some specific tax and direct and indirect tax. Then non-tax receipt. Non-tax receipts are classified further as fees, fines, escheat, special assessment, income from public enterprises, grants, donations. Okay, this comes under non-tax receipts. Okay, so non-tax receipts includes your fees, like land registration fees, birth registration. Okay, birth and death registration, your court fees. Okay, this is one sort of payment to the government. Okay, which we pay for the the services that it renders to the people. Then fines. Why do we pay the fines? If we violate any fine, if we violate any rules or any regulation, then we pay the fine. So this is the fine are those payment which are made by the breakers, okay, to the government by way of economic punishment. Then escheat. Escheat, it refers to that income of the state. This arises out of the property which is left by the people, okay, or the property which do not have a legal heir. Then it is called as escheat, and it is one of the part of non-tax receipts. Then special assessment, it is yet another source of non-payment revenue of the government. So this is that payment which is made by the owners, and this is of those properties whose value has been appreciated. Okay, so this term we have to understand, the appreciation, okay, due to the developmental activities of the government. Then income from public enterprise like Indian Railways, especially whatever the profit they get, okay, that is one of the non-tax source of finance to the government. Okay, then next is grants or donations. Grants received by the government, it's also a source of revenue. So it is like donation received for some sort of natural calamities or during a war. Citizen of the country often make some donations, no, and grants to the government. So this is called as grants and donation, which is a part of non-tax receipts. Then capital receipts. Okay, then we'll move to the revenue expenditure. This revenue expenditure, okay, revenue expenditure, it is estimated expenditure of the government in a fiscal year. Fiscal year during a particular accounting or financial year, okay, which does not create a asset or cause a reduction in liabilities. Okay, now these expenditure, it do not create asset for the government. Now these are those expenses which do not create any asset of the government, like where do a government will pay, what will be the revenue expenditure for the government. These are the example of revenue expenditure, like old age pension, scholarship, old age pension, then scholarship. Okay, these are some of the revenue expenditure. Then salaries, these are to be treated as a revenue expenditure. Then okay, so these are your revenue expenditure where the government is going to spend the money. It is they are going to spend on salaries, scholarship, old age pension. Okay. So these are revenue expenditure. Then coming to this part, that is capital budget, as I had told, capital budget includes two things, that is capital receipts and capital expenditure. Capital receipts are those monetary receipts. Now these capital receipts, these are going to create a asset or a liability. Okay, that is a creation of liability for the government. Okay, now capital receipts are especially we can say it is a borrowings of the government. So capital receipts are borrowings of the government, and so capital receipts are those monetary receipts. These create a liability for the government, and since it creates a liability for the government, it causes a reduction in the asset, okay, of the government. So for example, loans, borrowings, no, these are two sector enterprises to the private entrepreneurs, briefly called privatization. Now either a government can borrow money, okay, or they can do this disinvestment. Disinvestment is this privatization, converting the public sector enterprise and giving the shares of public sector enterprise to the private sector enterprises. So money received through disinvestment, it is treated as a capital receipt. Okay, then capital receipts are further classified as this, that is recovery of loans, borrowings and other liabilities, and other receipts. Okay, then Going back to this capital expenditure. Capital expenditure is expenditure of the government. We can say that expenditure of the government on acquisition of land, okay, building, machinery. So this is a capital expenditure. These are some of the example. So capital expenditure, it refers to the estimated expenditure of the government during a particular financial year, and this creates a asset or causes a reduction in liabilities. So expenditure on, just now we said, as land, building, machinery, okay, or any equipment. Then capital expenditure create asset for the government, okay, equity or the equity or shares of the domestic or multinational corporations purchased by the government. Then it causes reduction in liabilities of the government. So repayment of loans certainly reduces liability of the government. Accordingly, this is to be treated as a capital expenditure. Okay. So these are the components of budget, revenue budget and capital budget. Then then we have to focus on this plan and non-plan expenditure. Okay. Planned and non-plan expenditure of the government. So okay. Plan expenditure and non-plan expenditure. Plan expenditure refers to that expenditure which is related to programs under 5-year plans. So here we have to remember the programs under 5-year plans. Okay. So plan expenditure is those programs which comes under those 5-year plans of the government. Okay, like this includes, which are the plan expenditure of the government. This includes the consumption as well as investment expenditure, okay, by the government or planning commission of the country. Expenditure on agriculture, power, communication, industry, transport, public utilities. Okay, these are some of the example of plan expenditure. Okay, so which are the examples of plan expenditure? Agriculture, expenditure on agriculture, transport, okay, power. These are some of the expenditure. These are some of the plan expenditure of the government. Then again, health and education. So these are plan expenditure. Non-plan expenditures. These are the government expenditure which are related to programs on project formulated under 5-year plans. Okay, so this includes relief to the earthquake victims or construction of houses. These are sudden expenditure, we can say, which occurs due to the uncertain calamities. Okay, sudden expenditure. Construction of houses. So these are your non-plan expenditure. Then, broadly, any expenditure other than plan expenditure is treated as non-plan expenditure. Okay, so this is how the total government expenditure is classified revenue expenditure plus capital expenditure, or total government expenditure is equal to plan expenditure or non-plan expenditure, or total government expenditure is equal to development expenditure and non-development expenditure. Okay, so now we'll study with regards to development and non-development expenditure. Okay, development expenditure. It relates to the word development. It relates to the growth and development activities of the government. Okay, so development in certain areas like industry, agriculture, transport, roads. Okay, so development expenditure example: industry development on roads, transport, building a water canals. These are the part of development expenditure, or building bridges. These are the part of development expenditure. Generation of power, agriculture. So this includes loan given by the government to enterprises like Air India or Airlines. So these are development expenditure. Non-developmental expenditure includes it is an expenditure of the government which are relates to no development activities of the government. And which are the examples? These are very important. That is expenditure on administration, defense. Okay, expenditure on non-development expenditure, expenditure on defense. Okay, or we can say any expenditure on old age pension fund. Okay, so this is, or administration, defense. This is a non-development expenditure. Okay, then the next thing what we have to understand is what do we mean by budget deficit. Okay, so when we can say there is a budget deficit, okay, revenue deficit is also called a government deficit. It refers to a situation when budget expenditure of the government is more than the budget receipts. So we can say that there is a budget deficit. When can we say there is a budget deficit? When the expenditure, revenue expenditure, when the expenditure is, when the budget expenditure of the government of the government is more than budget revenue. Then we can say there is a budget deficit. So here we have to understand with regards to revenue. There are types of budget deficit, okay? Revenue deficit, fiscal deficit. So first thing is revenue deficit. With regards to revenue deficit, what do you mean by this revenue deficit? We have learned in revenue, we have learned revenue receipts and revenue expenditure. When expenditure, when revenue expenditure when the revenue expenditure is more than revenue receipts, then we can say that it is a revenue deficit. Okay, so this we have to understand with regards to budget deficit. Then there are certain types of budget. Okay, which are the different types of budget we have got? There are different types of budget such as balanced budget, unbalanced budget. Okay, the first one is balanced budget. Then we have got unbalanced budget. Okay, so these are some of the types of budget. First one is balanced budget. Balanced budget is that budget wherein government receipts are equal to government receipts are equal to government expenditure. Okay, this is called as balanced budget wherein your government receipts is equal to government expenditure. If we see what do you mean by unbalanced budget is that budget wherein the government receipts and government expenditure are not equal. So that time we have to, there are different terms which comes under this unbalanced budget. The first one is surplus budget. What do you mean by this surplus budget? So under unbalanced budget, there comes surplus and deficit budget. Okay, so surplus budget in is that surplus budget wherein your government receipts are more than the government expenditure. Government receipts are more than government expenditure. It is called as unbalanced, it is called as surplus budget. Then, see, estimated government receipt is more than estimated government expenditure. Okay, this is more. Then deficit budget. This is a budget in which government expenditures are greater than government receipts. So deficit budget, government expenditure is more than government receipts. It is called as deficit budget. Okay, so estimated government expenditure is more than estimated government receipts. This is called as a deficit budget. Okay, then the next thing what is left is with regards to how we can measure or reduce the budgetary deficit. Okay, so how a government can reduce its expenditure. Ways to reduce government expenditure. Which are the different ways to reduce the government expenditure? First one is that they can lower the government expenditure, and then the second is raising government receipt. How they can lower the government expenditure? The thing is, the government should try to reduce its compulsory expenditure, okay, and they should assign the work to the private sector, okay. So the private sector role to be increased. Then another term is non-development expenditure of the government, which includes subsidies like LPG, expenditure on defense, law and order, and transfer payment. These expenses are unavoidable and important. So non-developmental expenditure can be curtailed through cut on grants and aids offered by the government to enhance its vote bank. Okay, so this is how a government can lower its expenditure. The next thing is they can raise the receipts like taxation, direct taxation, a progressive tax in nature. So direct taxation is progressive in nature, which causes a greater real burden on rich, okay, than the poor. Indirect taxation is regressive as its impact is equally shared by the rich and poor. The scope for raising revenue through direct taxes is very less in India. Okay, so indirect taxation has a very wide regressive impact. So a government they have to see the balance between direct and indirect taxes, and heavy taxation on corporate sectors it lowers the inducement to investment. Okay, and the next thing is disinvestment. Here in disinvestment, they sell the government. They sell the equity. Okay, the ownership is sell to the private sector enterprise. So this is the process of privatization of public sector enterprise, or here they sell the government equity, okay, to a private sector. So this happens when the government budget deficit is high, when the government expenditure is too high. So disinvestment of PSUs, that is public sector undertaking, must happen when they experience recurring losses or in order to invest elsewhere. The proceeds of disinvestment must not be spent to finance populist policies of the government. Okay. So this is with regards to how we can curtail or reduce the budgetary deficit. The next question is explain the role of fiscal policy. Okay. Um, or why a fiscal policy is important. First point it is accelerate the pace of growth. Next is it offers a balanced growth. There is an inclusive growth in fiscal policy. Then there are chances of social equality and economic stability. So, accelerating the pace of growth in a welfare state like India, here there is a direct intervention by the government in the production process. Okay, through investment expenditure, defense and administration by the government is a key instrument of fiscal policy, which tries to increase the pace of growth. Then, balanced growth this helps to stop desperate migration of labor from one state to another. So here, government should encourage the subsidies, okay, um, and have to focus more on the backward areas. Then inclusive growth. Fiscal policy it focuses on inclusive growth of the economy, in which the participation of people is given a higher priority. Accordingly, the gains of growth are evenly distributed across all sections of society. So, in India, high expenditure by the government is spent on rural areas. Then, social equality. The government they try to achieve social equality and by offering various transfer payments to the weaker section while taxing the richer sections of the society. Here, a government has to maintain a social equality, okay, among the weaker sections. Then, economic stability. Due to globalization, there is a high degree of mutual interdependence among economies of the world, and through this has increased the pace of growth and it has also generated a higher degree of economic. So, here the government tries to maintain a fiscal discipline in the economy, okay, so that they can control the inflation and deflation, okay, gaps. Yeah. So, this is with regards to the government budget. Okay. So here we learned about various objectives, then meaning, structure of the government budget, which are the different tax receipts, okay? Then what are the ways to reduce government expenditure? What are the types of budget? Then we saw what is the budget deficit. Also we saw the plan and non-plan expenditure. what is development and non-development expenditure. Okay, so these are some of the things. Here you have to understand the components, and based on that the questions can be asked. Okay, um, thank you for thank you for watching my video.